Hello guys, welcome back to another new YouTube video. So in this episode guys, this is an episode for beginners. So if you're a beginner trader and you've been wondering when to buy in the market and sell in the market, this video is for you. So make sure to watch this video from the start to the end, because I'm going to be showing you step by step on how you can start, placing your first trades on your demo account, mostly on the demo account, because you're a beginner. So how you can first place your first buy trades or sell trades. I'm going to be showing you both the technical way and then the fundamental way. So without further ado, make sure to subscribe to this channel, hit the notification bell, and let's get started with this video. So guys, I'm going to be screen recording, so you'll be watching everything from here. So I'll start my screen recording right now. This is my trading view. This is the platform I use, TradingView. It's a very good platform where we can trade from. So what we see here is a downtrend. You see this here is a downtrend. This is a downtrend. Let's say if we remove these, so this is our downtrend market, as you can see. So if you ever go into your market, first thing you identify which type of market is it. Is it an uptrend or it's a downtrend? So right now we see a downtrend. So what we want to do is we want to apply our channel. So how do we apply our channel? We choose, we come here and draw our trend line like this. See? Something like this. So I'm going to first zoom out and draw a nice trend line, something like this. Something like this. Then again, you have to draw the second trend line. So I'm just going to clone it here. I'm just going to clone it. So this is my second trend line. So I'm just going to put it just there. So now you see we have a downtrend. You can see. So when the market is in a downtrend form, it forms lower lows and lower highs. So you can see here we have market dropping. So this is a lower low right here, and this is a lower high. Again, you have a lower low, a lower high. So how do we trade downtrend markets? So we only trade downtrend markets when you have retracements. Retracement happens to the upside, because since market is in a downtrend, so it only retraces up. So it means buyers are only trying to come in, to see if they can really take back the market up. But for some reasons, sellers drive back the market down. So this is where retracements happen always on this upper market. Because whenever markets retrace, you see this retracement move to the upside, the green candle, it's a short move. So meaning we target when market is going to now, after the retracement is done, we take another trend, which is a sell trend, and market will drop like this. You see this drop. So if we are to measure out how much this is, let's choose our measure tool and see how much this is. From up here, you can see, to down here. You can see these are so many pips. This is 2,751 pips. So these are like very many pips, guys. From that, so remember this is a 4-hour time frame, and this is US 30. So this is how we trade a downtrend. Whenever market comes to our retracement, and whenever we see market retracing to our upper trend line. So these two trend lines form a channel. So whenever market is in a downtrend, it forms lower lows and lower highs. So I'm going to show you something on my notes here. I'm going to draw out something for you so that you can see everything very clearly here. So this is what we have. So we have market forming. Lower lows. So this is a lower low. Then it forms a lower high. A lower low, lower high. A lower low, a lower high. So this is what we have. So what do? We just draw our trend line like this to form a channel. So we only take trades when market retraces at these levels here. This is where we take trades. We take sell trades, but we wait for confirmation that okay, market is now it has reached a time it's going to drop down. And one of the confirmations we can take is whenever market forms these V's. Whenever you see this V, you see this V shape, this is banks, putting in more liquidity to drive the market back down. This is where we see them, these big candles dropping big time. So this is how we trade the uptrend. So let's jump on to let's choose another currency here. We are going to choose the most traded currency in Forex. This is the Euro USD. So this is my USD. So we currently have an uptrend. So we currently have this uptrend. So you can see this is an uptrend. An uptrend is just a market going up. So if you're a beginner and you don't know what an uptrend is, it's just a market going up. So same thing here. We just add our trend lines. We add our trend lines like this. Then I clone that to the other side, just like this. So we have now another channel. We have another channel. So when a market is in an uptrend, it forms higher highs and higher lows. So this is what I mean. This is a market forms higher highs and higher lows like this. That's not good. Like this. Wait, like this. So these are higher highs and higher lows. These ones. So again, higher highs. These are high low, higher highs. Same to this, higher high, high low. So how do you take trades on the uptrend? We like to take trades on market retraces again. Market retraces when it forms when market retraces, it forms a high low. So this is where we want to take our trades, these trades. And then how do we take them? The other way we take them when we have our channel. So this channel is like also a confirmation. So so you can see this is my downward trend line. So we take trades on market taps these levels here. See, whenever it retraces, because these retracements are only short moves. So when you take a trade from here, you eat all the impulse move, because the impulse move is a longer one. This is where the most pips are. So this is what we have here. You can definitely see here. Let my chart load down. So you see what we have here. We have market impulse move, retracement. So you see the retracement is just a short move. So if we measure out the retracement, we can definitely see that the retracement only has 86 pips. But if you were to measure out the impulse move, it has more pips. So let's measure out the impulse move from here to up there. 203 pips for the impulse move. So take trades whenever market comes here to this downward, to the our downward trend, because it's just retracing. And whenever you see these V-shaped things, those are banks. It's the banks that move the markets like that. Retail traders can't move the market like that, guys. It's only the banks that move the markets like this, these V's. So we take trades in market, retraces like this. You see, whenever it comes to our retrace, we take trades. There's more analysis that we can apply to these uptrends and downtrends, but this is the best way for a beginner to start at least learning, and the simple way how we can start learning to buy, when to sell, So this is the uptrend. So let's see if we can find something like a ranging market. Let's see our 1 hour time frame. If this market is very clear for a ranging, let's see. Because a ranging market, I'm just going to show you here, illustrate here how a ranging market, how we trade in the ranging market. Let's see here. So a ranging market is we shall apply more demand and supply. So a ranging market is a market that's just ranging in between these levels like this. Something we draw our support and resistance. So this upper line is the resistance, this is the support. So when market comes here and again comes here, so draw here a line and then draw another line here. So this means this is the resistance and this is the support. So again, when the price comes back to this level, it's going to drop down. When it forms that V-shaped, that curve V-shaped there, it's going to drop to the downside. Take a trend. You get, because it's the banks adding in more liquidity to drive the market down. Again, adding more liquidity to the down from here to drive the market. So people that trade the ranging markets don't know that they think the market is just ranging in between, but it's the banks adding in liquidity, driving the market down. The reason why you can even see from the V-shaped banks, it's only banks that move markets like that. Retail traders can't move the markets like that. When you retail trader can just only move the market like this and it goes back up, you see. But the banks will have these V-shaped things, because we have a liquidity of $6.6 trillion that is being traded every day in the market, and banks move 85% of that money. So if you're a forex trader, you should know that also. Whenever you're in the banks move the most money in the banks, in the forex market, because they add in, they're ever exchanging money there. When the central bank wants this amount, they will do this. So this is how we trade the ranging market, guys. So if you're a beginner trader and at least now you know how to, these markets, how we trade them the easy way. The easy way how we can trade in these markets by either, using the channels on the uptrend, the downtrend, and all that, guys. So if you have enjoyed this video, make sure to hit the notification bell, make sure to subscribe, and make sure to follow me on my Instagram. My Instagram is at bagendajunior, guys. Make sure to follow me. I'll see you in my next video. Peace.